Welcome back. In this video, I'm going over how to best structure your business with your spouse. This video is going to go over tips for how to plan and structure your business for legality, accounting, and taxes. This will also include how a husband and wife LLC is taxed, as well as what a qualified joint venture means. This is a special election that's only available for married partners. If you're new here, my name's Amanda and you're watching The Business Finance Coach, where I simplify all of the technicalities of money and business, because I truly believe you should not be held back and struggling by these requirements and technicalities that are just here to support you. So if that sounds like something you'd like to have in your life, consider subscribing, which you can do while still watching this video. Also keep in mind, everything I cover in this video, from free things I give away to courses I have to the links that I show you for more information, they're all linked in the description below. Now let's jump into the options for how to structure your business as a married couple. Okay, so first we need to review kind of how businesses work. Every business has two types: a legal type, which is the law that makes it exist, and the tax type, which is how it's actually taxed. Tax type is based on the legal type. So when a spouse or any person starts working for themselves, they just start a business, maybe they just start performing some services and someone pays them, they are automatically a sole proprietor. They don't have to do anything to be that. There may be some requirements that they should be doing, but regardless, they're automatically a sole proprietor. The benefit of the sole proprietor is that the business isn't separate from the owner. The business doesn't need to have its own bank account, doesn't need to keep its own complete and accurate and separate records. Instead, the business just needs to keep track of business income and business expenses. And I give away the free business spreadsheet template for simple situations. Now, the biggest benefit to the sole proprietor is that for taxes, it's taxed as self-employed. This is the only type of business that gets to file their business tax return with the owner's return, because the business isn't separate from the owner. And so the business files Schedule C attached to the owner's personal 1040 tax return. The net income from the business, income minus expenses, goes over for taxes. Now, when we have two or more people in a business together, they're automatically a partnership business. You didn't file any paperwork with the state. Two or more people just started working. And the difference with a partnership is that the business does become a separate entity automatically because it's made up of more than two people, so it can't not be separate. Now, the general rule in a partnership is that the partnership business must actually file Form 1065, which is a business return that's due by March 15th. It reports all the business activity, and then that activity is divided up on Schedule K1s for each owner based on the percentage that each owner owns in the business. That's what happens when two or more people work together. What about when two or more people that are spouses? So if you have two spouses working together in a business like that, you are also a partnership. However, the IRS realized that this was a bit cumbersome to require you to file the partnership form and to report these Schedule K1s on your 1040. And so instead they said, you can use the qualified joint venture. You can make this election to instead each be treated as a sole proprietor on your taxes, which means that you'd report two Schedule Cs, one for each spouse, based on the percentage and their share of the income and activity. Now, as we can see from my spreadsheet template from my course, Choosing the Best Type of Business, there's literally no difference between filing the partnership return and reporting two Schedule Cs on your taxes. So the IRS is just saving you from this hassle of having to do this whole additional layer of reporting, and instead allows you to file two Schedule Cs. So the qualified joint venture is a great election. A few other things to be aware of. You can see this informational page at the IRS about the qualified joint venture. Both spouses must be actually materially participating in the business. I have another video that goes over that, but essentially you're both owning and working in the business. Another requirement you can see is that the business has not been incorporated. Now that means that the business isn't a corporation, but it also applies to the LLC. And you can see here specifically, if you form an LLC, you can no longer use the qualified joint venture.
So now let's talk about the LLC. A limited liability company, LLC, is a legal type of business. It's formed through a state government by filing formation documents with that state. Now, people form LLCs for what's called limited liability. For small businesses, an application, limited liability just protects them from being sued. When it comes to taxes, how the LLC is taxed depends on how many owners it has, and owners are called members in an LLC. So a single member LLC is taxed as a sole proprietor was taxed, which was called self-employed. So the single member LLC is called the best of both worlds, and it's a unique situation because it's a separate legal entity giving you that limited liability on the legal side, but on the tax side, no separate business tax return. Now, if there are two or more owners, members in the LLC, then it's taxed as a partnership, which is also called partnership for the taxes, which we have covered. Now, keep in mind that members in a partnership, they can never be paid as W-2 employees. They can never be paid as 1099 workers. Instead, they're paid through this Schedule K-1. And these businesses must also track something called basis, which is how you deal with your investment in the business and the value of the business. And again, it's just an added layer of complexity, which if you need it, great. But as spouses, you may want to skip all of this.
So what is one to do in your situation? So first, the simplest option is of course to stick with the self-employed tax filing. So you could do that two ways. You and your spouse could be owners of your business, and of course you could use the qualified joint venture just by filing that way on your tax return. Two Schedule Cs split the business activity. Now the other option, if you decide you do want an LLC for the business, is you could have one of the spouses be an owner of the business and the other spouse is not an owner of the business, is not on those formation documents with your state. Now the downside to that situation is that only one spouse is going to be getting credit for Social Security and Medicare taxes. However, in most states, so long as your spouse is not an owner in the business, you could pay that spouse through a 1099 or even a W-2, and then they would get credit. You just want to be careful in certain states like community property states where the spouse automatically owns the business because of the rules of the state. So those are the two simplest options because you're using Schedule C to do the taxes. So let's talk about these other three reasons why you might be looking at an LLC with your spouse and going the route of filing a partnership return. The first is validity. So often I find people are forming the LLC because they want to treat the business like a business and feel valid, brand themselves, have a business name. You don't have to use an LLC to do this. You can register a business name, which is called different things with different states, but you can register a business name and use that as your business name. Now, sometimes this is called a DBA, doing business as, sometimes it's called a trademark, sometimes it's called register a business name. So you can go through your state to set that up. It's much cheaper. And you're certainly always supposed to, in a business with two or more people, be treating the business as a separate business with its own bank account and keeping the money separate from your personal. So you can certainly brand a business name and create that validity without the LLC. In fact, most businesses are not putting their LLC or corporate name out there. They have a trademark or a DBA. Think of Coca-Cola, Airbnb. They have corporations and LLCs behind them, but it's not the name that they're branding and putting out there. So if validity is the reason that you're wanting the LLC, just know that you have this other option. Now, the second big consideration I see is for limited liability, and that is certainly a good reason to form the LLC, is for that limited liability. Now, you may want to consider what industry you're in, how many clients you have, like has your business actually gotten started? Do you even know this is going to work? Because you just don't want to spend a lot of time setting up an LLC if you don't have the business ready to go behind it and nothing ever comes of it. I see that happen a lot, and so that's why I mention it. Certainly, having the limited liability is a big part of why people form an LLC and a good reason to form an LLC. But some things to consider is that forming the LLC is not all you need to do to have limited liability. And a lot of small business owners are held personally liable, which was the whole point of the LLC, because they didn't do the other things you need to do to maintain the LLC. You have to actually treat the business as a separate business and keep complete and accurate accounting records. You have to keep your personal and business money separate. You cannot pay personal bills out of your business's bank account. And so you want to be sure that you're set up right. I have a great course that goes through all of this. So just be aware of that there's more to it than just filing a piece of paper. Also, if you want limited liability, you can get business insurance, which might protect you more than an LLC. Lastly is taxes. Now, it is certainly a myth that forming an LLC is going to change your taxes, right? We already saw that. Forming the LLC doesn't create another way to be taxed. You're either taxed how the legal sole proprietor was taxed for taxes, which is self-employed, or with 2 or more people, you're going to be taxed as a partnership. Now, you may have heard of the election for S corporation, which people advertise saves you money. That is completely a myth. There's no changes for taxes. In fact, typically people are experiencing more costs because of the additional requirements for the S Corp. You can check out my other videos on this that go over my spreadsheet from choosing the best type of business to form, where you can compare various tax situations. A sneak peek of that spreadsheet template, and you can see this worksheet is actually comparing the partnership to the S Corp. 80,000 of income, 30,000 expend at 50,000. I'm not going to get into the details, but ultimately the S Corp actually pays $269 more in taxes, and that's not even getting into the additional expenses. So yes, a partnership return is more complicated. It's fine if you're going to go that route, especially if you have a simple situation, but it's pretty cumbersome to learn about it yourself. So I would give a shameless pitch to my courses, which can really help you get through that quickly and with far less stress and confusion. So I'd love to hear if you have any questions in the comments below or what you decide to do. Again, if you're new here, consider subscribing. Check out the description for all the different links and things I've referenced throughout the video. And I'd love to see you next time. Bye.